Sure, the way the market is acting right now at essentially all-time highs, I think there could be a little bit of a give back, but I think that give back is going to be relatively short-lived. I think it's going to be met with buying interest. I think there's a lot of folks that have been waiting on the sidelines looking to get into the market, especially into the early cyclical trades, and they've missed it. They've missed it since September and October, and any kind of pullback, I think, would probably spur them on to do a little excess buying. Now, you could also include in that group folks that are going to see some pressure likely to come in the momentum-driven names, things like Zoom and Peloton and sort of the market leaders for 2020. And they'll probably use any kind of pullback in those names to, try to create a position. But I think that trade is probably a mistake. I think you'll have to sort of broaden out your perspective for 2021. The market is telling you that it clearly believes that 6 months to a year down the road, things are going to be better, not only on the coronavirus, but hopefully on the economy. With a new administration coming in, the hope for some type of stimulus, the vaccine being administered to folks around the world, the market is telling you that things are looking brighter. The momentum-driven names, the stocks that had sort of powered the market forward in 2020, I think are probably going to have to see some give up as folks rotate into the early cyclicals or quote value trade. Now, does that mean you have to exit out of things that have worked in 2020, like technology and consumer discretionary and communication? I don't believe that you have to, but I think you have to sort of be a little bit more cautious in your holdings on some of those areas. Again, if Zoom was the power to the market in 2020 because people were shut in or the economy was locked down and people weren't going into the office, how is that going to perform when people go back to the office, start having face-to-face meetings, people get back on airplanes to conduct business? There will be a place for Zoom, but I don't believe it's going to be sort of the forerunner to the market as it was in 2020. Zoom or Skype or something using Microsoft Teams or even using something like a Slack to be able to work remotely. I think the world is changing, and I agree with you. People are going to be conducting business differently. But there are still instances where folks have had to put on hold actual face-to-face meetings because of the pandemic. And I think Zoom has picked up a lot of that slack, and it's something that just the average person can use. But I think the way people really want to meet and work and interact is most likely face-to-face. I mean, we've had millenniums with people working face-to-face, and Zoom has just sort of picked up the slack in the last 10, 11 months. Again, I think there's going to be a place for it, but I don't think it's going to be sort of the driver behind the market. And because these are momentum trades, and I don't mean to necessarily pick on Zoom, but because these are momentum trades, the momentum can swing both ways. So I think you have to be careful with some of these names. But companies that have powered the market for years, for instance, Apple or Adobe or Microsoft, just focusing on technology, these are the companies that I think are going to continue to survive. In some regard, they are. They're different companies as far as the market is concerned. Amazon clearly has the power of internet shopping behind it, like Alibaba does. Tesla is a name that people look at and think that this is the future. People who are drawn to a Tesla stock aren't necessarily looking at the valuations, but they're looking at the leadership of the company, the potential for change on a global basis, They are drawn to that particular name because they're Tesla followers, such as Apple was in the beginning when Jobs announced the iPhone and iPod. But I wouldn't put them sort of in the same category, even though they're both consumer discretionary. One name is changing the world and the way people shop and making it more convenient, and Tesla is changing the world, but just in a different manner. And I think they draw in similar but different investors. What I do is a sort of a top-down analysis, and if you can sort of picture the economy, and both domestically and on a global basis, sort of in a sideways S pattern, there's going to be peaks and troughs. As the economy emerges from a trough and begins sort of an expansion phase, there are going to be certain sectors that outperform other sectors. It's classical cyclical investing, and people are using the term value synonymous with the early cyclicals. Early cyclicals would include things like basic material, industrials, energy, financials, and these are the areas of the market that would see the biggest benefit as an expansion phase begins to emerge. And then it's a matter of populating the portfolio with individual stock names. I think that you would probably benefit by focusing on basic material industrials first. Energy, the world is changing with sort of the carbon-based fuels. Financials, it really is going to be dependent upon what happens with the Federal Reserve and the new administration. Interest rates may be getting a little bit higher, but I think they're going to be peaking at a time relatively soon. So I'd be looking for opportunities in basic material and industrials, but then I would also be, maintaining exposure to things that have worked. Technology, consumer discretionary, communication. I think those are that's the type of positioning that I think a sort of a balanced or barbell type portfolio is going to work well in 2021. And then it's a matter of finding those individual names and not having too much exposure to sort of the momentum driven names, but to the companies that have the greatest potential for both revenue and income growth.